Welcome back to the Deep Dive.
Great to be here.
Today, we're diving into something I find fascinating, analyzing a single company stock.
Right, how one document, one report can just, tell such a complex story, sometimes even contradictory.
Exactly. And our focus today is Cineverse Corp. The ticker is MEDIA.
They're in streaming technology and entertainment, operate quite a few channels, SVOD, AVOD, FAST.
Plus content distribution, home entertainment, that sort of thing. Even physical media, believe it or not.
And our source material is this stock report dated June 27, 2025. Pretty comprehensive.
Yeah, it gives a snapshot of, well, everything. Financial health, valuation, market momentum.
But what really grabs you is the mix. You see some signals that look incredibly strong and others,
Wow.
well, frankly, quite weak.
So that's our mission for you today. We're going to try and unpack these contradictory signals.
We'll walk through the key bits, analyst takes, the numbers, the metrics.
So by the end, you'll have a much clearer picture of Cineverse and maybe how to think about these kind of, confusing situations.
All right. Ready to dive in.
Let's do it. Okay, so the report kicks off with this overall label for Cineverse, expensive star DVM.
Right, and that DVM framework, durability, valuation, momentum, is key here. Expensive star. It immediately sets up this tension.
What does it usually mean, an expensive star?
Generally, it suggests, bullish signs, decent quality, good technicals. But
The valuation's poor.
exactly, poor valuations. It's a warning, really. Be cautious on returns because it might already be priced high. Popular, but pricey.
Okay, so bullish, quality, but expensive. Let's break down that DVM, starting with D, durability, financial strength.
Yeah, and Cineverse scores a 56 out of 100 here. The report calls that high financial strength.
So anything over 55 means good, consistent performance, stable revenue, cash flow, low debt, based on long-term data.
That's the idea. A 56 looks solid on the surface.
But there's a catch, right? Looking at its history.
Well, yeah. Historically, its durability score has actually been bad, more often than good. Like 58% of the time it was bad.
Huh. And its peak score before now was only 55.6. So this 56 is basically its all-time high.
Pretty much. And the low point was way down at 16.7. So while it looks strong now, that strength hasn't been, a constant feature.
Which makes you wonder, what's driving this current high score? Especially since it's second only to Disney among its peers.
Yeah.
Disney's at 67, Cineverse 56.
It's a good question. How does it manage high durability now, given some of the other things we'll see? It hints at maybe recent improvements or specific strengths balancing out weaknesses.
Okay, let's pivot to V's valuation. And this sounds like where the story flips.
It really does. Score here is just 14 out of 100. That's firmly in the expensive valuation zone.
Below 30 means expensive, not competitively priced.
Right. Suggests the strengths, whatever they are, might already be baked into the stock price. Maybe even overbaked.
And historically.
Historically, its valuation score has been bad 100% of the time. It's never really looked like a bargain based on this metric. Max score ever was just 28.5.
Wow, okay, so still expensive today. Even among peers, it's pricey third highest score behind Live Nation.
And the specific ratios really spell it out. Price to earnings, PE, TTM, it's negative 6.1.
Negative PE means no earnings, basically.
Correct. And look at the returns. Return on equity, ROE, is minus 65.4%. Return on assets, ROA, minus 28.6%. These are, well, they're really bad numbers, fundamentally speaking.
Neatly negative. But, hang on. The report mentions PEG TTM. Price earnings to growth, that's 0.3.
Ah, yes. And that's where it gets, really confusing, because a PEG under 1 is typically seen as good. Suggests growth at a reasonable price.
No, how?
Yeah.
How can the PE, ROE, ROA be so awful, but the PEG looks positive? It's a direct conflict.
It is. Often this happens when maybe the company is expected to grow earnings dramatically from a very low or negative starting point. The G in PEG becomes very powerful mathematically.
So the market's maybe betting on a huge turnaround, ignoring current losses for future potential.
That could be the narrative, yes. Makes that future growth look cheap relative to the price, even if profits aren't there now. But it's definitely a higher risk bet.
Okay, makes sense. Let's move to M, momentum. How's that looking?
Momentum's actually quite strong. Score is 65 out of 100. That's technically moderately bullish.
So buyers are interested. Technical charts look good compared to the market.
Yeah, suggests buyer demand. And momentum is seen as more of a short-term thing, remember. Historically, this score has been pretty decent for Cineverse, good about half the time.
And the technicals back this up. moving averages.
They do. It's trading above all 8 simple moving averages and all 8 exponential moving averages. That's a classic bullish, signal-strong, consistent recent uptrend.
Lots of laters, too.
Most of them, yeah. 7 out of 9 are in the bullish zone, so multiple indicators pointing the same way.
Okay, sounds pretty good. But is there a but?
There's always a but, isn't there? The RSI. Relative Strength Index is at 71.
Yeah, and over 70 is usually.
Overbought, yeah. It suggests the recent rally might be a bit stretched, maybe due for a pause or a pullback in the very near term.
Right, so strong momentum, but maybe getting a little overheated.
Exactly. And this short-term strength versus long-term pain is just stark when you look at the returns.
Oh, yeah, the returns. Tell me about those.
Get this. 1-year return, positive 450.6%.
Wow, 450%.
Huge run-up. But the 5-year return, minus 87.4%.
Whoa. Okay, so a massive recent surge after years of, well, decline. That is quite the contrast.
It really is. And maybe the biggest head scratcher, considering all this, especially the valuation in history, is what the analysts are saying.
Don't tell me.
Yep. Consensus recommendation from the 2 analysts in the report, strong buy.
Strong buy. Seriously. After negative PE, negative ROE, expensive valuation.
That's what they're saying. And the average price target is $8.50.
What's the current price again?
$4.57 as of the report date. So that $8.50 target implies 86% upside potential.
86%. And the range is $7 to $10.
That's correct.
Yeah.
Low $7, high $10.
So, okay. How do we square this? Expensive stock, negative historicals, mixed durability history, but high momentum recently, and analysts screaming strong buy with massive upside. What are they seeing?
That's the million-dollar question, isn't it? It forces you, the listener, to think. Is this purely about future hope? Are they completely discounting the past and the current valuation metrics? Or is there something under the hood driving that optimism?
Let's dig a bit more with the Trendlyne checklist. Maybe that gives more clues.
Yeah.
How does Cineverse score there?
It's okay. Passes 52.4% of the criteria. That's 11 out of 23 checks. So basically a coin flip, a very mixed bag.
Right. Let's break it down. Financials first. How many checks there?
Only 1 out of 7.
Just one. Which one?
Low debt. Their long-term debt to equity is 0, which is great. Very low for the industry.
Okay, low debt is good, but what did it fail on?
Pretty much everything else fundamental. Consistent profit growth? No. Consistent sales growth? No. Strong ROE? No. Positive net cash flow or CFO? No.
And wait, it failed the durability check too, even though the DVM score was 56.
Yeah, this is interesting. The tech list uses a stricter threshold, wants a score of 60 or more for its high durability check. So 56, while high in DVM terms, doesn't pass the specific checklist item.
That just shows how different frameworks can read the same data point differently. Very telling.
Absolutely. So financials look weak on this checklist, apart from the debt.
Okay, what about value and momentum on the checklist? How did it do there?
Better. Met 5 out of 8 criteria here.
So this aligns with the DVM momentum score being high.
Exactly. It passed checks for the momentum score itself, showing bullishness, trading above all those moving averages we mentioned, bullish candlestick patterns, active breakouts, all positive technical signs.
But where did it fall short on this section?
On the value side, mainly. It failed the check for being in the buy zone based on historical PE or price to book, basically confirming it's not cheap compared to its own past or typical value benchmarks.
So again, reinforces that expensive valuation tag. Momentum good, value not so much.
Precisely.
What about ownership? Who's buying or selling?
Ownership looks pretty positive overall, met 3 out of 4 checks.
Okay, like what?
Institutions bought more in the last quarter. Promoter holdings, the founders, key insiders are stable or maybe increasing. And institutional holdings overall have risen over the past year.
Those generally sound like votes of confidence, right?
Yeah.
Big money moving in, founders holding tight.
Usually, yes. But the one check it failed is important context.
Which is?
Insiders have sold stock in the last 3 months.
So institutions are buying, but some executives or directors are selling.
That's a classic mixed signal. People closest to the company taking some money off the table.
It can be for many reasons, of course, but it's something to note when you see institutions piling in.
Definitely. Okay, last checklist area, Pew comparison. How does it stack up against competitors?
Met 2 out of 3 here, so reasonably well against the industry.
I agree the positives. Better long-term returns than the industry average, which is interesting given that negative 5-year overall return. Maybe the industry was even worse. And its sales growth, is better than the industry median.
Okay, but it missed one.
Yes. Profit growth. Its profit growth is not better than the industry median. Again, hitting that profitability theme. Sales might be growing relative to peers, but profits aren't keeping up.
Got it. So the checklist confirms the picture. Low debt, strong momentum, some positive ownership signs, but struggling with profitability, historical value metrics, and consistent financial growth.
That sums it up well. It's a patchwork quilt of data points.
Let's look closer at the actual financial numbers then. Annual performance, revenue.
Total annual revenue came in at $49.1 million, but that was down 27.8% year over year.
Down nearly 28%. And is that trend getting worse?
The report says yes. It notes that total revenue annual is falling faster than its historical average decline. Not great.
Ouch. Okay, what about the bottom line, net profit?
Also negative. Annual net profit was a loss of $21.4 million, and that represents a decline of almost 120% year over year.
Minus 120%, so the loss widened significantly. And that trend?
Also accelerating, according to the report, falling faster than historical averages, so bigger losses happening faster.
This sounds bleak, but you mentioned an outlier earlier.
Yes. The EPS, earnings per share. On a quarter year-over-year basis, it showed growth of 272.7%.
Whoa. How does that fit in? Massive EPS growth alongside accelerating revenue and net profit declines.
It's startling, isn't it? The report flags it as a market runner-up. It could be due to things like significant cost-cutting finally hitting the bottom line for that specific quarter, maybe a one-off gain, or perhaps share count changes, but it stands out dramatically against the other negative trends.
A single green shoot in a struggling garden, maybe. Okay, balance sheet and cash flow quickly.
Trends there are also a bit concerning. Total assets are falling annually. Total shareholder funds or equity also falling.
Not ideal. Anything positive?
Well, working capital annual showed a positive trend up 119% year over year. So its short-term liquidity position looks better, more current assets than current liabilities.
Okay, that's something. But cash flow from operations, the core business generating cash.
That's negative. Cash from operating activity annual is negative, and like revenue and net profit, the report says it's falling faster than historical averages.
So it's not generating cash from its main business activities, and that situation is worsening. That feels fundamental.
It's definitely a key area of concern for sustainability, yes.
All right. So historical performance and current fundamentals look challenged, to say the least. But what about the future? What are those optimistic analysts forecasting?
Yeah, the forecasts for fiscal year 2025 and 2026 are, well, they're very upbeat.
Like how upbeat?
For FY25, they expect EPS to grow 105.6%, net income to grow 102.3%, revenue up 56.5%, and free cash flow expected to surge by 143.0%.
Wow, those are huge growth numbers, a complete turnaround from the historical trends we just discussed.
Absolutely. It implies a massive inflection point is expected very soon.
But how reliable have these analysts been in the past for Cineverse?
Well, that's the crucial context. The report mentions their track record is mixed.
How so?
For example, actual EPS beat the average analyst estimate only once in the past 2 years.
Okay, so they tended to overestimate EPS.
No, wait, sorry. Other way around, for EPS only beat once, meaning they underestimated that one time, perhaps. But for net income, revenue, and free cash flow, the actual results were lower than the average estimates twice in the past 2 years.
Okay. So for key metrics like revenue and net income, the analysts have generally been too optimistic in recent history.
Correct. That track record definitely adds a layer of uncertainty to these very bullish FY25 projections.
Oh.
Are things really different this time? What underpins that forecast?
It really makes you question whether those strong buy ratings are based more on hope and future projections than on current reality or past performance accuracy.
It certainly puts the emphasis squarely on believing in a significant near-term turnaround story.
So let's try to synthesize this. We've got Cineverse Corp. The report tags it expensive star DVM.
Meaning high durability score currently, but inconsistent history. Very expensive valuation, confirmed by negative ratios and checklist failures. Strong momentum recently, but maybe overbought and after a terrible long run.
And then you overlay the analyst calling it a strong buy with huge upside targets based on forecasts that have historically been, let's say, ambitious.
While the company itself shows declining annual revenue, widening losses, and negative operating cash flow, albeit with low debt and that one spike in quarterly EPS growth.
It's a classic puzzle, isn't it? Technical strength, analyst optimism, clashing head-on with historical fundamentals and valuation warnings. How do you navigate that as an investor? Which story do you believe?
Exactly. And that leads us to our final thought for you, the listener.
And consider this. In today's market, flooded with information and analysis, what drives stock prices more? Is it the forward-looking story, the analyst projections, the short-term momentum?
Or do the underlying historical financials, the valuation realities, eventually win out? For Cineverse Corp, with all its contradictions, what stands out to you as the most compelling piece of this puzzle? The bullish momentum and analyst hope, or the fundamental red flags? Something to think about.